All right, let's talk about Rocky Mountain Chocolate Factory. They just dropped their earnings and boom, the stock tanks 7% right out of the gate. So what's the deal here? Is the company just in a tailspin, or is this the bumpy start to a big turnaround story? That's what we're going to dig into today. We're going to break down these latest results and see if we can figure out what's really happening.
Okay, so here's how we're going to tackle this. First, we'll look at the market's immediate reaction, how investors voted with their wallets. Then, we'll get into management's big plan for a comeback. After that, we got to talk about the real headwinds they're facing. And finally, we'll wrap it all up with our take on what to watch for next and our rating.
So, first up, the market's verdict. The numbers at the wire before the market even opened. And traders, well, they didn't waste a second showing us how they felt about the company's story versus the cold, hard reality of the financials. And there it is, a 7% drop in early trading, right after the numbers came out. You don't really get a clearer signal than that. That's the market basically shouting, nope, we're not buying it. A definite vote of no confidence on this earnings print. Okay, so this is where things get really interesting and, frankly, a little confusing. On the surface, you see revenue up almost 7%. Hey, that's not bad, right? But then you look closer. Look at the gross profit. It completely flipped, going from a positive number to a loss. I mean, think about that. It's costing them more to make and sell their chocolate than they're bringing in from sales. At the same time, cash is getting torched and debt is climbing. That is a tough picture.
And that disconnect we just talked about, this quote sums up exactly why the stock got hit so hard. Management can talk all they want about making progress, but the market, investors, are looking straight past that and are zeroed in on the bottom line. And right now, the bottom line is showing persistent losses and serious pressure on those margins.
All right, so given those numbers, what's the story from the C-suite? How do they explain this? Well, their narrative is that this isn't a sign of failure. No. They're telling us this is just a painful but totally necessary part of a much bigger turnaround plan.
And this quote from the interim CEO, Jeff Gagin, really captures their whole message. He's basically saying, look, the hard part, the planning, the strategy, laying the groundwork, that's done. Now it's all about execution. It's time to actually deliver results.
So how are they going to do that? Well, they've laid out a 3-part plan. First, they're going to modernize the stores. Second, upgrade all the behind-the-scenes infrastructure. And third, they're really trying to get that franchise pipeline growing again. And to their credit, this isn't just a bunch of buzzwords on a slide. They're taking real, tangible steps. We're talking a brand new flagship store in Chicago, a new loyalty program to get customers engaged, and they've brought in some heavy hitters, new VPs for ops and franchise development. They even bought one of their own stores in California to use as a real-world lab to test out all their new ideas. Pretty smart.
Okay, so that's the plan, and it sounds pretty good, right? A lot of positive action. But investors are clearly not convinced. They're seeing some pretty big red flags that are giving them pause. So let's do what analysts do and read between the lines a bit.
And this really is the million-dollar question, isn't it? All these turnaround plans sound promising, for sure. But here's the catch. They all take time, and they all take money. The huge uncertainty is whether the company has enough of both to get there before that weak balance sheet becomes a real, critical problem. And this slide just lays that conflict bare. It's like two different worlds. On one side, you have management's story, a renaissance for the company, the strongest pipeline in years, a new era of growth. But then you look at the market's reality, persistent losses, negative gross profit, cash just flying out the door, and more debt. It's a classic case of story versus numbers. Yeah, let's just visualize that balance sheet pressure for a second. We're talking $2 million in cash versus almost $8 million in debt. And get this, a chunk of that debt, nearly $2 million of it, was just added this quarter to keep things running. That is not a lot of breathing room. The runway is getting short. And if that wasn't enough, they're also getting hammered by cocoa costs. Now, you might have heard that cocoa prices are finally starting to fall from those crazy highs, which is good news. But, and this is a huge but, that doesn't help RMCF right away. See, they have to sell through all the expensive chocolate they made using the high-priced cocoa they already bought. So any relief on their profit margins is going to be delayed. It's a classic inventory lag, and it makes the next couple of quarters absolutely crucial to watch. All right, time to bring it all home. Let's put all these pieces together. What's our forward look? What does this mean for the stock? And what are the key things we need to be watching for when they report next? When you boil it all down, it really comes down to this one central tension. It's a race against time, plain and simple.
On one hand, you've got a solid operational plan to fix the business. But on the other hand, you've got this financial clock that is just ticking louder and louder. Whichever one wins that race is going to decide where the stock goes from here.
So if you're following this story, here's your watch list for the next 3 to 6 months. Number 1, holiday season performance. It's everything. 2, the new Chicago flagship. Does it open on time and does it bring in foot traffic? 3, the digital stuff. Do people actually sign up for and use the new loyalty program? And maybe the most important of all, gross margin. Do we finally see it start to turn positive as those lower cocoa costs work their way through the system? That's the big one.
So with all that in mind, our rating on the stock is market perform. Here's why. The turnaround plan itself, it's credible. Management seems to know what they need to do. But the execution risk is just massive, and that balance sheet gives them zero room for error. Until they can prove this plan actually translates into real bottom-line profit, we think the upside is pretty limited. And finally, let's talk about a potential trade idea here. And just a heads up, this is definitely a more speculative play. The idea is this. You wait, you stay on the sidelines, but you watch that Q4 report like a hawk. If, and this is a big if, they show a clear, undeniable improvement in gross margin, that's your signal. You could consider a long position, betting that the market will have no choice but to stop pricing this as a distressed company and start seeing it as a real turnaround story. So there you have it. That's our full breakdown of Rocky Mountain Chocolate Factory's quarter. Of course, please remember, this is all for informational purposes. This is not financial advice. Always do your own homework.